Hey everybody, hope everyone is doing well and had a good day. This is going to be a recap of the Emini 5-minute chart for Tuesday, April 8th, 2025. And if we look back, we had a big gap up. Maybe it doesn't look that big, but if we look at it, this was more than 2.5%. It's a pretty big gap up. And I have yesterday's high in this blue horizontal line. I really want to look at the Globex chart, what we had going into the day, because I think it shows some clarity. You know, when Al talks about 50% of breakouts on the open will fail, no matter how strong they are, they'll fail and go the other way. That statement always kind of confused me. And it was Brad Wolf that helped with that clarity, because he would always show the Globex chart in his E-mini reviews, and it cleared things up, and we talked about it in Systems Academy as well. I remember someone else asking a question about it, but the point is, when you have a big gap, there's a lot of missing information, but if you simply look at the Globex session, you can fill in a lot of that missing gap, the missing information. So, with that said, here's basically what we're working with going into the day. So over here is the close of yesterday. And here, you can call it a bull channel. We were creating higher lows and higher highs, but vast majority of this price action is really sideways. You know, if you draw a rectangle, like I said, you're getting higher lows and higher highs. You can call it a bull channel, but this is mostly a trading range. And then later on, this is more toward 7 or 8 a.m. Eastern time. We got the bull breakout, pullback, second leg up. And if we look at the 5-minute chart, had to pause the recording, so I forget exactly where I left off, but I think I was going to talk about the 5-minute chart on the Globex going into the day. I know, at least I want to, because it fills in some of those gaps. Literally the gap, the blank space between yesterday's close and today's open. So here's the first maybe 10 bars on the 5-minute chart using the 5-minute Globex session. And it paints a different picture, because what do we have here? We might have 3 legs up in a bull channel. And if you don't know what happened within the gap, it's hard to say what leg this breakout, maybe 5 through, I don't know, looks like a micro channel up to bar 10. It's hard to say what leg that is when you don't know what happened here. So it can be really helpful, at least to have an idea of what happened in the Globex session. So I wanted to show that before going back to the day-only session, so that we have that image in our mind, because you combine that with, like I said, yesterday's high, often support or resistance. And here's the day-only daily chart, bottom left of my screen. This bull doji was yesterday, and strong bear breakout, this doji bar. If the most important thing for a trader, the most important decision, is whether there's going to be more buyers or sellers above and below the prior bar, if we just ask ourselves, is there more likely more buyers or more sellers above the high of yesterday, based on the context? Strong bear breakout, closing big bar and closing far below, many bars to the left, and then a trading range bar, a doji signal bar for the bulls. If we get above this high, there's probably more sellers above. Trading range, buy low, sell high. So the context is more bearish, and it's a trading range, so probably sellers above. And then you combine that with the fact that this might be leg 3 in a channel in the Globex session, then this might be a better area to look to sell, then to look to buy. So big gap up. Bars 1 and 2, and it's kind of deceiving. These bars, bar 1 I think was about 20 points, 21.50. So bear trend bar, follow through, but big tail. And after the gap up, we know there's a bull channel on the Globex chart. And the first reversal might be minor. The bears might have to do more of a trend line break here, or we may have to go more sideways. Inside bar 3, range contraction, so lower high, higher low, breakout mode. Because of the big gap, it increases the chances we'll get a tradable move in the direction of the gap in the first hour, which we did here. And it began, you could say it began on bar 5. But bar 5 was an outside bar. And bar 5 being an outside bar, you know it's a trading range bar. It's an expanding triangle. Breakout below the prior bar's low, breakout above the prior bar's high. 6, follow through buying, and 7, more follow through. But no micro gap. Really not great follow through bars. Trading range bar 6, big tails, relatively big tails and a smaller body. Even smaller body 7 with big tails. This might be a channel on a smaller time frame. But nonetheless, it's a 3-bar micro channel, and the odds are it will get some sort of second leg. In other words, the first reversal attempt will probably be minor. We had a micro channel all the way up to bar 10. Bar 10, probably buyers below, but getting lots of overlap over the past 3, 4, 5 bars, small bodies, big tails, breakout mode, and far above the moving average. So if you're a bull buying up here, we think logically about where we are in relation to the moving average. If you're buying up here, far above the average or fair price, the moving average is one measure of average. If you're buying here, you're buying momentum. And you have to ask yourself, is this good momentum for the bulls? Trading range bar 7 looks like almost an outside bar, almost 100% overlap, failed breakout, lots of sideways. It's really not great momentum for the bulls if you're buying this far above the average. And eventually, bulls will take profits and bears will begin to sell. So what began happening up here? Range compression, once again, expansion, bull breakout, but then we started to go sideways. Might be a final flag. It might be a bull flag and a bull trend, which leads to a bull breakout. But because we're so far above the moving average and we're getting sideways average price action, we may have to go lower to find traders willing to buy, to find bulls willing to buy, to find a price where bulls are willing to go long, and find a price where bears are willing to take profits on shorts. So 15, bear trend bar, it's a breakout, many bars to the left, maybe 5 or 7 bars, closing below the low of all these bars, and then a follow-through bar, and 16 tested the breakout point. You could say the breakout point was the bar 13 low, you could say the bar 7 low, but 15, really decent trend bar, closing below, 16 retesting this breakout point, maybe not quite reaching 14. You can see it just barely missed it. And that's a gap. So there is a micro gap between the low of 14 and the high of 16. And breakouts with micro gaps tend to have more shallow pullbacks. They don't get deep pullbacks. There are trapped traders here. If you bought below 14, just imagine you bought below bar 14 and 15 is your entry bar. Well, if you scaled in, maybe you buy the close 15, your average price is the midpoint between the 14 low and the 15 close. Maybe you have an opportunity to exit the trade at break even at the average price. But if you try to exit at the 14 low, you don't quite get there on 16. And the risk here is that this was a bull leg in a trading range. The bottom of the trading range could be all the way down at the low of bar 2. And the bears would end up getting more and more follow-through selling. 15, 16, 17, 4, 5 bar micro channel. And the bodies, this is not very climactic. 18 is a little climactic if you draw a channel line. 18 is breaking out below, so maybe we pull back. But the first reversal after this, probably going to be minor. Bulls will argue double bottom, but you have to measure the approach, or in other words, the momentum. So yes, double bottom, but do you really want to buy bar 18 or bar 19? Is 19 a major reversal, or is it minor? Is it going to undo all of this selling? Probably not. First reversal, likely to be minor. In other words, the bears will probably get a second leg, and the second leg will probably be more symmetrical than simply bar 20. Bar 20 is probably not the second leg the bears are going to get after this breakout, because you know there are trapped traders up here. And we continue to sell off. So technically on this chart, this is still a breakout. There was no spike break. 19 did not go above the high of 18. 20 did not go above the high of 19. So this is a micro channel all the way down to bar 22. We finally got a spike break, bar 23, going at least one tick above the high of bar 22. So that's the first technical pullback. Al will say an opposite bar 19 is a pullback. It's an implied pullback. There's almost certainly a pullback on a lower time frame. So it doesn't really matter if you say the spike ended here or here. You know this is a bear spike, a bear breakout, and what's next in the market cycle? You get a pullback, and then the channel phase, a weaker trend phase, but probably lower prices before we reverse back up. And just ask yourself over the past 10 bars, how easy has it been for a bull to make money? Even a limit order bull, since bar 13, 14, limit order bulls are not making money. So there's really no reason to be buying. You certainly don't want to buy above 22. I think 22 is one of those bars that traps a lot of beginners because the risk is small. It's a reversal bar closing near its high. If the trade works, maybe you can make 2, 3, 4 times your risk. And that's what attracts beginners, is small risk. But the trader's equation has 3 variables, and beginners only think about risk. So you have to think about risk, reward, and probability. And maybe you do have good risk reward. Maybe you can make 4 times your risk on the trade, but the probability that you do might be 20 or 30%. And for me, my personality, I prefer taking trades in the higher probability direction. '25, '26, the bulls finally got a pair of bull bars, but they're not especially big, and they're following a tight bear channel. So tight bear channel, trendline break, but not enough bars for a major reversal. And again, the bars not especially big, not much bigger than the average bar going down here. So for the major reversal, where are the big consecutive bull bars? And where's the significant trendline break? It doesn't really exist. And instead, we get range compression. So expansion, breakout, and then compression, trading range. It's a triangle, lower highs, higher lows. The bears see a triangle bear flag. The bulls are hoping for a triangle major trend reversal, maybe a final flag, one final breakout for the bears, and then a reversal up, maybe at least into a trading range. But after this much selling and the strength of it, the best the bulls can hope for is a trading range. There's so many trapped traders above, and the market may have to go lower before we find traders willing to buy. So we're in this triangle, we get the breakout 34, follow through 35. And what happens? The market comes back and retests some breakout points. We have the 24 low, the 29 low, breakout, follow through, 36 pulls back, but 36, you have to ask yourself, what is bar 36? And you always have to ask yourself the bull case and the bear case for really every bar, every tick. What does a bull see? What does a bear see? The bulls see a late leg, maybe a couple ways to see leg 3, 1, 2, 3, maybe 1, 2, 3, not a traditional wedge shape, but 3 attempts down. And then a bull bar closing on a tie. An outside bar, it's a pretty good bull trend bar. But the bears see what I had drawn earlier, the triangle bear flag. And what they see for 36 is a breakout pullback. Bear breakout pullback, but 36 to a bear is simply a vacuum test of resistance, testing breakout points. So some bears see a bar like 36 as a discount, and they see a bear trend, they see a bull bar closing near a tie. Some bears will sell the close because in a bear trend, bears sell rallies, and they take profits at new lows. Outside down and follow through, but getting several legs down. 39, a smaller bar, so it's still another bear breakout, another 3-bar micro channel. It's a late leg, but if you, I'm going to draw this triangle one more time. Bear breakout, trading range, and then a new bear breakout. This might be leg 1, and this might be leg 2. And if it's leg 2 and a trend, you treat it differently than you treat a leg 2 and a trading range. Is this a second leg trap? I don't know. Probably not. Doesn't look all that clear to me that we're in a trading range. And if we are, it's a very big range, and we may go all the way down here, maybe even lower. We've already closed the gap, and the bears have pretty good momentum with many bars collecting below the moving average. So might be leg 2 here, but still okay to sell. Minor reversal, another leg down, minor reversal, another leg down. Now, I want to talk about Al's 80% rule, the 80-20 rule. In a trend, 80% of trend reversals fail. And how many reversal attempts, if we count stop orders, have failed since, if we reset the leg count here after the triangle, we have 1, 2, 3, 4. That's 4. And you expect 4 out of 5 to fail. And there's 5. So you expect this to fail, 2, 3, 4, 5. This one may actually succeed in converting market into a trading range. But just because the 80% rule, it says 80% of trend reversal attempts fail, that doesn't mean on the 5th one we're going to get a big bull breakout and an opposite trend. This channel is too tight. This is a breakout on a higher time frame. Chances are, even if we get a trend line break, the reversal will be minor, and the best the bulls can hope for here most of the time is a trading range, not a major trend reversal. Decent breakout 50 and 51. It'll probably get a second leg. That's enough to probably make the market go sideways for at least 5 or 10 bars. And there might be buyers below 50, but again, this is probably not the start of a bull trend. It's probably more going to be a trading range. And we ultimately went sideways for maybe 10 or 15 bars. But once again, the bulls hoping for this to be a major trend reversal, trend line break, retest of the trend's low, and maybe it's a wedge, 3 or 4 legs down, double bottom. So maybe major trend reversal above bar 64, but tail on the signal bar, bad entry bar, bad follow through. more and more bulls may give up on the major trend reversal premise here. We haven't even had a bar close above the moving average here. So this all might just be a minor reversal. And then there's a give up bar, 68. But we're getting late in the day, and you might count 3 big legs down, 1, 2, 3, increased chance just because it's a channel. You expect most breakouts of channels to fail. We're approaching that channel line, so the downside here might be limited. We're getting a sell climax late in a trend, many bars into a bear trend, far below the moving average. This might end up attracting profit taking by the bears. As we get late in the day, it's not uncommon to see profit taking rallies at the end of bear trend days. Is bar 71 a major reversal, or is it minor? It's probably minor. I think because of the context, it's okay to exit above 71 if you're a bear, but the reality is the best the bulls can hope for here is similar to here, and here is a trading range, and probably not a big reversal up. There's just a minor reversal before more selling, but still, again, this might be, who knows how you count the legs. Maybe it's a reset here, second leg down, pull back, 3 legs. It's hard to count legs in a trend, or it's, I should say, less important to count legs, the with trend legs in a trend. Better to count the counter trend legs in a trend, because if you're counting counter trend legs and you're counting reversal attempts, and after 2 or 3 reversal attempts, you can look for a low 2, low 3 to sell. But if you're counting legs in the direction of the trend, you'll just inevitably find wedge bottoms that ultimately fail and break out to the downside. But again, it's getting late in the day, and seeing profit taking late in the day is not uncommon, and bar 77 may be just that, probably more due to bears taking profits than bulls aggressively buying. So still here, even after a big bar 77, best case for the bulls is probably a trading range. It looks like after, I don't know if bar 27 closed above the moving average or 19, but from here or here, we haven't had a bar close above the moving average in maybe 70 bars, and that is pretty strong selling. I like to wrap up my videos by reminding everyone that I'm just a student of Al Brooks, and these are just my interpretations and ideas as I do my recap, but I really urge everyone to visit the Brooks trading course. You can find the link to it in the description of my videos, because I'm just a messenger, and for the source of the real information, you can go to the direct source himself, Al Brooks. I'll also recommend Ali Moin-Afshari. Brad Wolf is also another great resource. Just be sure to study the video course and don't use these recaps as your main source of studying. That's what I would say. And that's going to be it for this one. Thanks everybody for watching, and I hope everyone has a good night.